Hello and welcome to our February edition of Amundi Market Review. Three topics drove market sentiment in January. First, the US Federal Reserve monetary policy sequencing. Second, a broad-based deterioration in the growth-inflation mix. Third, geopolitical risks have been on the rise with tensions between Russia and Ukraine leading to higher energy prices, oil was up 16%, and the start of the election cycle in Europe. In Italy, President Mattarella has been re-elected for a second term and is keeping Mario Draghi in place as Prime Minister. Starting with the Fed, the prospect of the US Central Bank withdrawing their pandemic-era support, as signaled by Jerome Powell, was the big event that shocked markets. Investors now expect the Fed to embark on its first hike in March and to increase rates about 5 times this year to stamp out inflation. However, we're keeping a more cautious stance. We expect the combination of growth cooling progressively to trend and inflation remaining high to allow the Fed to deliver 4 hikes in 2022. In any case, markets are likely to remain nervous as long as inflation does not retrace meaningfully lower, and we expect this to materialize over the summer, when inflation should fall below 5%. This should ease pressures on the Fed regarding the pace of the monetary policy tightening, while giving political relief to the Biden administration. The debate on the Fed animated the fixed income market, with US rates selling off. Following the Fed's announcement, 2 years US Treasury, the most sensitive to rate expectation, rose sharply, closing the month more than 40 basis points higher. 10 years US Treasury lifted 26 basis points. European curves mirrored this dynamic with a less pronounced move. 10 years Bund went 14 basis points higher in the month. Moving on the second topic, we noticed a broad-based deterioration of the growth-inflation mix. In our view, the economic momentum will slow down and growth should abate progressively to trend in 2022. In China, the Omicron outbreak complicates the recovery path in the third quarter this year. Holding to a zero-tolerance policy, local governments stepped up social distancing rule ahead of the Chinese New Year, which will weigh on mobility and service consumption again. In the US, the release of the GDP numbers for the fourth quarter 2021 was much stronger than expected thanks to the rebuilding of inventory. Restocking makes sense to dilute supply chain bottlenecks, but is likely to be only a temporary boost. Consumption is the main driver of a sustainable growth. We expect it to slow down as disposable income diminishes progressively due to inflation being higher than wages increases. In fact, we expect a more lasting inflation trend globally. Current price dynamics reflect one of the price shock, and there is little central banks can do to contain the increase of energy and food prices. Vice versa, monetary policy has to consider the issue of price shocks translating to a dynamic of further price increases, as it seems to be the case in countries such as Germany or in the Nordics. Moving on to our last topic, geopolitical risk has been on the rise and we expect tensions between Russia and Ukraine to de-escalate progressively. We believe financial sanctions on Russia are unlikely to hurt the strong Russian economy unless they stop the country from selling oil and gas, which would also hurt Europe. Italian presidential elections close in the name of continuity. The re-election of President Mattarella could potentially be the best possible outcome for Italian spreads that were volatile in January. This outcome creates a period of stability and allows Prime Minister Mario Draghi to continue working on the reforms, in particular putting the European Union funds to use in April. How did risk assets react to these economic and political events? Credit spreads were resilient and their widening stayed under control thanks to the high level of cash in the balance sheet and high revenues for most issuers. We should avoid margin compression even in an inflationary environment. We remain constructive on the asset class, but we progressively reduce the exposure to credit. This sell-off in rates was bearish for equities. Volatility is and will remain huge. All equity markets, with the exception of euro value, are flashing red, minus 7% for the S&P 500, minus 4% for European equities, minus 6% for the Japanese topics, and the Hang Seng Index is almost flat. The corporate earnings reporting season is in progress and shows deterioration in guidance to the Omicron impact that is expected to drag results down for the first quarter this year and pressures from inflation, but a bright spot should arise from capital expenditure. To conclude, we do not think The recent market moves are an entry point and we maintain our asset allocation. This means we keep a neutral exposure to equity with a preference for Europe and Japan, which should continue to benefit from high inflation. We also maintain our exposure to short duration and limit our exposure to credit. Thank you for listening. Please keep safe and see you next month for another market review.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น